Ultimately, it is this expectations for sticky inflation, and really the inability of the Fed to control its move. And I think when we think about sort of core CPE, which is expected, and I think this is really, and you mentioned it earlier, it's all the rate anxiety in the market. I think this is ultimately what is causing the volatility, and rates are higher. Our own fixed income model has been expecting higher rates because ultimately the data out of the US is still fairly resilient when we look at PMIs. I think that PMI number last week was quite a shocker.
Indeed, and we're also counting down to the PCE number at the end of the week as well. Is that going to be critical in helping us determine whether or not we've actually seen a peak in yields?
I think that's really, really crucial. And I think that data point is going to be scrutinized heavily. When I step back and try to think about why the markets are reacting in this way, I do believe it comes down to the fact that we've moved away potentially from a soft landing scenario to potentially stagflationary, which is very difficult for markets to navigate because ultimately you do have lower growth prospects in the medium term, but you do have that higher sticky inflation. And the direction of the Fed was, very broadly expected to be sort of rate cuts. But now if we think about what is priced in by year end, it's only cuts of about 33 basis points, and that's come down significantly. And I think it's that breadth of outcomes with regards to what the Fed might be doing, which is leading to this volatility and this concern and intense focus on the PCE data.